Hi, everybody. This is Josh Nelson, dialing in from lovely Loveland, Colorado. It's beautiful outside. We've got picturesque winter day. So I don't know where you're dialing in from. We've got people down south, someplace warmer. So good for you. Hopefully you guys get to go play golf and enjoy the weather today. But we're enjoying some beautiful winter on our end. So we're going to give people a couple more minutes and get started for Forecast 2019. A couple of logistics as we get going. We've done a couple of these face-to-face, and we always like to throw in some options where people can dial in remotely, not only because sometimes it's more convenient for people. First of all, even if you're just down the street, you might be at your work and you might not have that time to drive someplace. So we always like to make it convenient for you. Secondly, a lot of people don't live here anymore. Sometimes I meet you here in Loveland, Colorado, or someplace else, and then you move across the country because of work or because of retirement or be closer to the kids. So we also want to make sure that the opportunities are available regardless of where you live. And then finally, these are recorded. And so for people who can't make it live, in fact, most people end up watching these as a recording because of their schedule, it's available. So we're going to be recording this today and we'll make it available afterwards. So if you do think of somebody that you'd like that should be attending this, maybe it's a spouse, maybe it's one of your kids or a coworker or a friend, we always want to be here as an educational resource. Back when I started at the credit union, at First Tech Credit Union now, it used to be called Addison Avenue, but at First Tech Credit Union, we used to have the opportunity to be right on the HP sites, and we recorded a lot of these presentations and did a lot of them live because I think it's extremely important that people are educated when it comes to finance, because if people aren't educated, oftentimes they make decisions that aren't the best. And of course, we want to be your guide going forward to make sure that you're equipped to be able to do that the best way possible. So as we come up here on the hour, a couple of housekeeping items. First of all, we've got a couple of boxes. If you go to your GoToWebinar toolbar, we've got a couple of things in there called questions and chat. So questions and chat, if you would locate those, because those are really helpful to be able to communicate with me. I see Mark on there. Hi, Mark. So on the questions feature there, you can use either one. Actually, that'll help communicate with me along the way. But questions that you might have along the way during the presentation, that's the best way to ask, actually, is to be able to throw it into the questions queue, and then I can either answer those along the way, or if we need to move along for time purposes, I will go ahead and just hold them till the end. We'll certainly leave some time at the end to be able to ask. So with that being said, it looks like we've got a bunch of people signed in, and we'll go ahead and get started for time purposes, if nothing else, because I know a lot of you have other stuff going on. That's one commonality I would say of all my clients is that they're all busy people. And they're all really smart people too, but they're busy people, and so that's why they hire me, right? Because they don't have time for this, right? They know it's important. They know they need a guide to help them with their finances, but they also don't want to spend all their time in their retirement or their career, or when they could be spending time with their kids or their grandkids. Probably not the best thing to be spending all your time trying to follow the markets or becoming a financial expert. So with that being said, I'm going to go ahead and turn my webcam off, and then we'll go ahead and get going on the actual presentation part of it. And I'll come back on at the end, but it's good to be able to see each other, right, when we can. So first thing here is I want to make sure that everybody can see my slides. If you can't see my slides, then please type something in under chat or under questions. If you're having trouble hearing me, any logistical stuff, let me know. But I really enjoy doing webinars, and it's nice just because we give people a really flexible option to be able to participate. And so I definitely appreciate the people that are on live. And again, I know many of you will be dialing in later. In fact, on all of our webinars, I don't think we've had a single one where we've had more people live versus watching the recording, because again, people are busy, they've got meetings, they've got activities, they've got stuff going on with their family. So we definitely want to make sure that it's available to you. And also, these are available to anybody who wants to attend. So if you've got coworkers or friends or family that you want to be sharing this with, certainly let them know. And we want to be able to help your friends too, even if they're not clients right now. We certainly can help them to be able to see stuff. And somebody just commented they can't see my screen. So let's make sure you can see my screen. Let's see, show screen. There we go. My bad. Thank you, Mark, for pointing that out. So hopefully everybody can see my slides right now. You should have a big slide that says Forecast 2019. All right, thank you. So this is one of the things that I enjoy, even though I'm not as tech savvy as some other people. So anyway, forecast 2019, return to volatility, and I think that's a really important thing to just recognize, that it is the return of volatility after having a pretty long span of time where we didn't have a lot of downs in the market. That definitely has come back in 2018. Certainly, we saw a lot of that, and I think this is going to be the same thing this year. Volatility is not always a bad thing necessarily, because volatility also can result in bigger ups on the other side of it. It also can eliminate a lot of inefficiencies in the market, but it's not necessarily the most comfortable thing in the world to go through. So more than anything, it's important to just understand the landscape of things, and that's what we've always done during forecast and during our halftime report, is try to keep it educational and keep it to a standpoint of trying to help you understand, so we can be a better guide to you and you can make better decisions. So with that being said, my name is Josh Nelson. I think everybody who's on the call probably knows who I am, but if you don't, or if somebody's watching this afterwards, I'm a certified financial planner, the CEO and founder of Keystone Financial Services, which our beginnings, believe it or not, were out of HP, out of Hewlett Packard back in the day. In the early 2000s, I actually started working there at their credit union, and about that time, there were some huge changes that were happening with the company, between spinoffs, layoffs, downsizing, mergers, all kinds of craziness. And through that, as you can imagine, there were a lot of people impacted by it, some positive, but in a lot of cases negative, and a lot of financial decisions that people needed help with. And that's what we did at the credit union, is act as their resource, almost like an extra HR person that helped them with their benefits, their retirement planning. And then in 2010, I broke away and started Keystone, which it was not my lifelong dream to start a business. It just kind of evolved into that over time, that I had enough relationships with clients, and I had become an expert financial planner, and realized, you know what, I think I can actually do this better for people if I'm on my own. If I can make all the decisions myself, basically, and chart the course for my clients, we'll be in a better situation. So a couple of things about Keystone. We are an independent firm, so we don't work for any company. We don't work for a big corporate entity where somebody else is telling us what to do or what we should be recommending to our clients. So it's really important to recognize that we are independent, so we can be giving you advice that's in your best interest. That's what's called a fiduciary. Fiduciary is a kind of financial language for those of you who aren't familiar with it, but it means that there's a legal obligation that the person that you're working with gives you advice that's in your best interest ahead of their own. Which you might think, well, duh, isn't that why you would hire a financial advisor? And that's true. That is why people would hire a financial advisor. But the key, I think, is to think about the motivations and the fact that most of our financial industry, most advisors are not a true fiduciary. In other words, they do have some conflicts of interest. They get paid on commission. There are sales incentives from their companies that would cause them to steer their clients one way or the other. Not a great situation. So we are a fiduciary, meaning that we do have to put your best interests first, and we want to put your best interests first. I'm very public about that because most people don't realize the difference. And then finally, we do comprehensive planning. And it's not just me. We also have a team. So I've got a cohort actually popping up on the screen. So you've got Renee Bolger, our managing director. We've got Sarah Bjork, our wealth plan administrator. Jeremy Bush, our second financial advisor, and also a client relationship specialist. And then we've got two interns, Sarah and Jared, Sarah Still and Jared Van Vark. Actually, Sarah just graduated, so congrats to Sarah. She actually just moved to Chicago, but she's still helping us out remotely. And then finally, Gail Perkins, our director of First Impressions. So you do work with a team when you work with Keystone, not just me, not just one person. So with that being said, in Forecast 2019, this is what the attorneys wrote, so you can read that very quickly. And then we'll move on. What we always talk about in our forecast presentation is where we've been, where we are, and where we may be going. But first, we like to warm up everybody's brains, especially people who have already eaten lunch and you hit those afternoon doldrums. I'll ask you a few questions here to warm things up. So how long is the perfect book? How long is the perfect book? And there actually is an answer to this, but how long is the perfect book? I can tell you that we've got 100 or less came in under questions, so feel free to use your chat or your questions. So what do you think? Is it the short book or the long book or the medium book, in other words? So our guess that came in is 100 or less, and it's actually believe it or not, just the opposite. Books with 1,000 pages or more had the highest ratings of books, but it's not because of what you think. It actually ends up being that if people commit to that long of a book, what it turns out is that people actually feel like they have to justify that they invested that much time. So that's the reality, is books with 1,000 or more pages had the highest ratings, but that's why they've determined that people made that decision. So second thing, which country snores the most? So Luxembourg, the United States, China, or Brazil? Which country snores the most? Yeah, it's funny to think about how would they know this, right? But obviously they do sleep studies in all these countries, and we've in all over the world for that matter. So we know this. So which country snores the most? And yeah, guesses of China, guess of the U.S., United States, and the answer is Luxembourg, believe it or not. And more entertaining, I think, than anything is the on the slide here. It actually shows that people tend to snore a different amount of time based on their age. So people tend to snore more over time, but women actually peak with their snoring at age 50, and it goes down after that. So kind of funny that, first of all, that they actually track this, and funny to think about different countries having different snoring rates. So this one, I can tell you, I have not located the pet beverage brewery in the Rocky Mountains yet. So that one, I don't know if it's true or not. We'll have to see what your guess is here. But which of these businesses is not a real business? Which of these is a fake, in other words? The pet beverage in the Rockies, a spa for guinea pigs in the English countryside, which would be interesting. We actually have 2 guinea pigs. I don't know if I would pay for them to go to a spa. Hang gliding tour for dogs in Patagonia, or a 5-star hotel for cats in Malaysia. We actually had some clients that just got back from Patagonia. I don't think they saw hang gliding. All right, we've got guesses coming in. Got the brewery, the pet beverage brewery in the Rockies is a fake. I've heard hang gliding is a fake. Yeah, interesting. People will do anything for their pets, right? And the reality is that you cannot take your dog on a hang gliding tour of Patagonia, at least not yet, right? There's not such a thing. And then finally, which activity burns the most calories? And again, it's snowy here right now. We've got a lot of people probably sledding, but also grocery shopping, golf, mowing the lawn. Any guesses on this one as far as which activity burns the most calories? Yeah, this one's a little, let's see, we have mowing, we've got sledding that came in, grocery shopping is, and golf, I guess, yeah, with a cart, probably not. It's, depends on if you walk or not, right? But ultimately it is sledding because you have to walk back up the hill, right? That's why. I suppose if you were at a luxury sledding resort, maybe you've got some kind of a lift, but if you have to walk back up the hill, that is a lot of calories that you've got to burn. So with that, let's move forward to where we've been. And I can tell you, December was a crazy month. That was a lot of volatility that we have not seen in quite some time. And this shows you from the beginning, these are all the market days of December. But if you look at the beginning of December on, there really wasn't much to be happy about. Most of the volatility was on the downside. So we saw a lot of losses, and to the point where it erased the gains that we had seen earlier in 2018. But it's interesting, we actually had some volatility at the beginning of the year too. And one thing that I've noticed with clients and just people in general, and even myself, if I don't kind of stay up on my market history, but it's funny how quickly we forget about what's happened in the past, even when it wasn't that long ago. In early 2018, we saw one of the best Januaries ever, followed by a horrible February, which erased all of those gains plus some. So that would be a market correction, right, or 10% or more drop that we saw in the market. And then really the rest of the year, most of the rest of the second quarter, the third quarter actually were very good. We saw some decent gains. And then it was almost spot on at the beginning of the fourth quarter. We started seeing volatility pick up, started seeing those gains go away from losses. And then, of course, December, we saw a lot of down days in there. And when you think about percentages applied to 26,000 on the Dow, you see those are pretty big drops. Obviously, to see 500,000 point swings in the market was the worst Christmas Eve ever. it's the one day of the year that financial advisors can count on, that they can just kind of pack it in, right, and not worry about the market. But I was actually back in the Midwest visiting family, and I kind of heard the news, and it's like, you've got to be kidding me. Market dropped that much. Crazy. So that was Christmas Eve. And then the other good thing is, after Christmas, December 26th, things rallied. We saw a 5% gain, but in the end, it was a negative month for sure. And again, 2017 was so calm. It's kind of like flying. If you fly any distance, or if you fly a certain number of days of the year, sooner or later, you're going to have volatility on your flight. You're going to have turbulence. That's just a normal part of flying. But sometimes you have severe turbulence, and most people do not like that. That's not a pleasant thing to experience. Even if people aren't mortally terrified of flying, they're still probably not comfortable when turbulence kicks up, or if there's really heavy turbulence. So you can see that this is the long-term moving average, is that black line in between. That's kind of the market average as far as volatility. And you see 2017, we were kind of off the charts on the bottom end, that very, very little activity as far as bounces in the market. Of course, you can go back to 2008, 2009, huge amount of volatility both years. 2008, it was volatility on the downside was the trend, and then the volatility in 2009 was all ups. Basically, after March of 2009, we saw a lot of gains, but still lots of bouncing back and forth. And then 2018, again, back up to the mean. So you can see that even though 2018 didn't feel good, it actually is more of an average as far as the number of days that we saw volatility both up and down. So falling share prices, you look at the contrast between the 2 years now that we can compare them, and this looks at the Dow, the NASDAQ, and the S&P. If you're wondering, by the way, which index you should watch, it's not the Dow. The Dow, it's a trend. It usually follows with the S&P 500, but one thing to recognize is that the Dow is only 30 stocks versus the S&P 500 is 500 stocks, all of them in the U.S., but keep that in mind, is that sometimes even if one stock in the Dow has a big problem, that can cause a huge amount of volatility on the downside or on the upside. So I like to watch the S&P 500. If you look at the 2 years, though, obviously we ended up with a negative return in 2018, which is pretty surprising. I think most people did not expect that. I certainly didn't expect that, and that was not in my halftime presentation that was given last summer. So unfortunately, staying diversified didn't necessarily help. Even if you were very diversified across all the sectors, you still would have seen a drop in your portfolio. Really, there were only a couple of sectors that saw any kind of a positive return, slightly positive in consumer discretionary, healthcare, and utilities, but still nothing real exciting. Certainly not anything to offset the big losses that we saw in some of the other sectors like energy and materials. And other asset classes didn't help either, just by having different asset classes. That's one of the things that we always have in people's portfolios, is they have multiple asset classes to help reduce volatility. But again, it was a pretty tough year. 2017, it was like you could do no wrong, right? You could kind of throw your financial dartboard, right, and you would have won. You would have made money in 2017, although you can see a diversified portfolio in 2017 would have gotten a decent return, but not a huge return. For example, U.S. large cap stocks did very well. Emerging markets did very well in 2017, but obviously a lot of that got erased in the emerging markets the next year in 2018. So keep that in mind. Having multiple asset classes, it actually does help you over time, but there are certain markets and certain months, in particular December of 2018, when pretty much everything went down. So you basically couldn't do anything right. In other words, it didn't matter what you invested in. You probably saw some losses in your portfolio. And again, international investments, we're looking at these different ways, right? I like to think of people's portfolios and look at them three-dimensionally. In other words, look at them from one angle, we can see how much they've got in different countries. Look at another angle and how much do they have in big companies versus small companies. And then different types of companies, tech versus telecom versus healthcare. It's important to have diversification in lots of different ways. But in 2018, it did not help to have international stocks in your portfolio unless you were invested in Qatar. And I can tell you we did not have any quiet money invested in Qatar. So that probably did not help you if you were invested with us. But a lot of international markets saw some big sell-offs, especially in emerging markets, really saw some huge losses in returns. So the big surprise, I think, is that people, if they're kind of looking at things logically, and if you imagine if you had gone on a trip to Mars where you had no internet access, you couldn't have any maybe communication with what was going on in the world, and somebody presented you with information and they said all of the S&P 500 earnings are very positive and we're seeing double-digit gains, 25% plus in corporate earnings growth, and we've got record unemployment, and we've got GDP growth growing in a healthy way globally, and we've got interest rates reasonably low and inflation relatively low. So you look at all these things, that's kind of the normal formula that you would look to see whether conditions should be good or not. Well, if you were that person on Mars and came back and saw what the market did, you'd be scratching your head and wondering, how did that happen? And it happened for a number of different reasons, but one of those certainly is that it wasn't just about current earnings, it's about earnings in the future. One thing that makes market timing virtually impossible, and in fact I would say impossible because even the most successful investors, say Warren Buffett, for example, will tell you that they don't know how to time the market, that they have never met anybody who can consistently time the market. And the market in and of itself is actually a forward-looking indicator of things to come. So the stock market tries to anticipate, in other words, what could happen in the future. And that's why it's so difficult to time the market, because once you know those other factors like unemployment, GDP growth, and so forth, the market's already reacted and obviously guessing what could happen in the future. So the fact that earnings weren't as good as some investors were hoping, I think that was a big part of it. Also, because of statements made by the Fed chairman and by the president to a lesser extent, but especially the Fed chairman. So ultimately, it's kind of crazy though. Earnings have been really stellar. It's been quite some time since we've seen the growth level that we've seen this past year. And sometimes I get the comment, well, that's kind of fake though, isn't it? Isn't that just because we had the tax bill that passed in late 2017 and it put a lot of money back in the pockets of corporations? It is true. That's true that it certainly helped. But that was only attributed to about half of those gains. 25% growth, again, we talked about 12.5% of that was attributed to the tax cuts, where we went from being one of the highest corporate tax nations in the world down to average. That's kind of where we are right now, is at an average corporate tax rate. So, and believe it or not, that's actually one thing that, even though there may not have been bipartisan support on that particular bill, there actually was bipartisan agreement on that concept that we were too high. Both Democrats and Republicans said that was putting the U.S. at a big disadvantage. So that actually was part of that bill and did help earnings. But the other 12.5% is actually real, right? That's real earnings just from companies doing well. And the reason why they do well primarily is because of us, because of each one of us as consumers, because about 70% of the economy is represented just by you and I spending money. And right now, pretty much anybody who wants a job has a job. You're looking at a 50-year low right now in the unemployment rate here in northern Colorado. I think we're one of the lowest in the nation right now. So pretty much anybody who wants a job has a job. They may not have the job they want. That's a different story, right? So sometimes there can be arguments about people being underemployed, or in other words, that they're not in the job that they qualify for, that they're actually far more educated and trained than that job. But nonetheless, people do have money, and a low unemployment rate is certainly a positive for the economy when consumers have money to spend. And then because of the losses that we saw late in the year, PE ratios definitely got more attractive. But let me unpack this, because for those of you who aren't familiar, this can get a little bit wonky. In other words, for us financial experts, this is stuff that we don't want to just talk through it and not take the time to make sure everybody understands. So the trick is that if you just look at prices of stocks, we've gotten to all-time highs, right? The S&P 500, the NASDAQ, the Dow all hit record highs this past year in 2018 before falling off. But one thing you have to consider as part of that is earnings. And if earnings growth has been very positive while prices have been falling, which we saw in the fourth quarter, what that's done is it's made stocks worth a lot more from a value standpoint. So if we compare price to earnings, what's happened is that the price to earnings ratio on the market has come way down because of those price decreases, yet the earnings increases. It's actually made stocks come down to those dotted lines, which show you the long-term average. So the stock market is more of an average price-to-earnings ratio right now than if you look back to 2000, for example. We also hit all-time highs in 99 and 2000. Unfortunately, though, the earnings weren't there to support the prices, and so what ended up happening is you saw a big sell-off then that happened in 2000, 2001, and 2002, which brought valuations down to more normal levels. So it's not a good thing to have prices just run if there's no substance behind them. The good news, at least for this past year, is that earnings have helped out. Earnings have actually kept up and grown at much higher than average paces, which have basically justifies where prices are right now. And then Treasury yields moved lower late in the year. That's one thing that actually helps borrowers, right? If you're borrowing money, that's great. And so kind of coming back to the consumer, because the consumer is the number one part of the economy, if it's making it easier to borrow for houses and cars, things like that, obviously lower interest rates are going to help. And if interest rates go way up, the trick is, like they did back in the 80s, and you can see on my left-hand chart there, yields got very, very high on mortgages, treasuries, because the Fed was fighting hyperinflation at the time. So obviously we had to suffer through a recession and some pain with really, really high interest rates for a while. But the trend since then, over the last 30 plus years, has been interest rates coming down to much lower levels. So when we have very high interest rates, it's very bad economically to stay up at those levels, because that ends up acting as a tax on consumers, on businesses, and believe it or not, even on the government, because much of our government spending is funded by borrowing. If the interest rate is higher on all those securities, that means the government is actually having to pay much higher interest to the investors that are buying those bonds, whether those investors be individuals or pension funds or other governments that are investing in our U.S. debt. So economically, that could actually exacerbate things in the future. And that's one concern, certainly, that's being voiced, is that if our interest rates go much higher in the future at a time when our expenditures are going up, largely because of Medicare, Social Security, Medicaid, those are projected to kind of go off the charts here over the next 20 years. And if interest rates are much higher, that's going to make it even more difficult for borrowing to happen from the government to be lending to other countries. So something to watch, certainly. Right now, our debt to GDP is not off the charts, even though we're at record levels of debt. Really, we're not that crazy at this point. Certainly nothing like other countries like Japan or most European economies. So interest rates are still low overall. And this is Powell's comment, by the way, Jerome Powell, who's the Fed chairman. And Janet Yellen was the chairman before, and Ben Bernanke was the chairman before, and Alan Greenspan. So if you remember these names from back in the day, it's all the same role. And to a large extent, this is the person that actually has a lot more power in a lot of ways than the president or Congress does, as far as changing the economy, because they can do it much more unilaterally. In other words, it's much more difficult for other branches of government to be able to get in and make changes. So the Fed chairman basically alluded to the fact that, hey, we think that the economy is still strong enough. We're going to be raising interest rates really over the next year. And they were still projecting up to 3 to 4 quarter point interest rate increases in 2019. The market really didn't like that, especially with inflation low. The justification for continuing to raise interest rates really wasn't there in the minds of investors. So that did cause a lot of selling that ended up happening at in the last month of the year. Why is that? Why are people so concerned about that? Well, again, higher interest rates end up being a tax on the economy. And if interest rates are going up and the investors say, you know what, that's not necessary, what it could actually do is it could be detrimental for economic growth. It actually would put us into a recession. And if we look over Fed history over decades, more often than not, the Fed actually is too aggressive and they raise rates too quickly, and it ends up putting us into a much worse economic situation than what we would need to be. Now, that being said, there is such thing as cycles, right? We go through cycles like we do seasons of the year, and they go in fits and starts over time. But right now, we're probably in the fall, and I talked about this at the halftime report in 2018, is that we're probably in the fall of the economy, meaning that it's good. Right now, the numbers are good. We're probably going to continue to see good numbers here for a while yet. But the season that comes after fall is what? It's winter, right? So winter is coming, whether you're a Game of Thrones fan or not. Winter is coming, And economically, if the Fed continued to be aggressive about interest rate increases, it actually could push us there faster than necessary, and it could put us into a much worse recession than what we would need to have to get through all the inefficiencies and things that can tend to get burned out. You have a lot of companies, a lot of excesses that get burned out in recessions. So not saying the recessions are good necessarily. Maybe they are, maybe they're not. So we won't debate that. They just are. And it's kind of like seasons of the year, whether you like them or they're not. You like them or you don't like them, they're there, right? That's just part of the experience. So one of the concerns too that people had, especially in December, is that the yield curve temporarily inverted. And again, this gets kind of wonky, but you may have heard some of this in the news because sometimes economists will say that an inverted yield curve is a prediction of a recession, that we're headed towards recession. So we went there briefly. We're not there anymore, but we did have a slight inversion in the yield curve, which basically means that instead of interest rates going up with longer maturities, they actually end up going down with longer maturities, which doesn't really make sense, right? You would think about borrowing money from your friend, for example. If you had $20 and or your friend had $20 and you wanted to borrow it, and they might just be your friend, right? And they might say, yeah, borrow it. No, you don't have to pay me back any interest. Maybe they're a really good friend and say you don't have to pay me back at all. But that's not normally how things work. Normal economics is that you pay your debts back. When you borrow money, you pay that back. And if it's for any length of time, especially when it's not your friend or not a family member, you're going to expect that there is going to be some interest due. Otherwise, they wouldn't have lent you the money in the first place. So when the interest rates, when the length of time goes up, the maturity level goes up, you tend to have to pay higher and higher interest rates. And to use the example, if you go out to the internet right now and look at what you would pay on a 30-year fixed mortgage versus a 20-year fixed mortgage or a 10-year fixed mortgage, you're definitely going to pay lower interest rate for the 10-year fixed mortgage. But of course, that's less risk to the bank, right? Because you've got a lesser amount of time until they'll be paid off. And so there naturally is going to be some reward for that. So I think at the end of the day, it's one of those things that yield curve inversions do happen. If they stay inverted, which again is not right now, if they stay inverted, that really can be a sign that investors are forecasting a recession. So it doesn't always end up being that way. This is not a 100% predictor. Short-term yields, basically it's investors expect short-term yields to be lower in the future. It could be that. So it could be that there's just a forecast of lower interest rates, inflation to be lower in the future, which actually is predicted right now, that inflation is still going to stay pretty contained right now. And fundamentally, I think that's the other reason why the Fed has backed off from their statements now and basically getting a lot more neutral, saying that they're going to be much more patient as far as rate increases because they don't feel like they're pressured into it right now. Versus in the late 70s, early 80s, for those of you who remember those times or maybe at least your parents, you remember them talking about it, is that inflation was out of control. We had hyperinflation, and that's really bad economically when inflation gets out of control. And it's the Federal Reserve's job basically to keep inflation at a steady level. So with inflation getting out of control, the only thing that they really could do to contain that is to raise interest rates and raise them aggressively. So that is one thing to watch. Certainly if inflation starts to tick up and with very, very low unemployment rates, that actually can lead to a lot of wage growth, a lot of extra benefits companies are giving their employees, which we think, well, isn't that good? It's good because then the consumers that you were talking about have more money in their pockets. That is true. But the cause of inflation is prices going up. And the reason why prices go up is that companies don't like making less money. And so if their costs are going up, they're going to pass most of those costs on to their consumers, to their customers. And as that happens, that's inflation. If we're paying more for our bread and our electronics and our plane tickets, all that stuff, then that's inflation. That's what it gets calculated to the consumer price index. So if that gets to be too crazy, then that ends up being a huge tax on us as consumers where we can't buy as much stuff because we're having to expend more dollars to be able to buy the same things that we used to buy. So some level of inflation is not a bad thing, but keep in mind that those cost increases can get out of control, and that's when the Fed really will feel pressured to raise rates more aggressively. So we're going to move on to where we are, but I'm actually going to pause here for a little look at the questions. So One question from Tim here. He said, you said it's bad to raise interest rates too quickly. What happens if the Fed is too conservative and doesn't raise interest rates quickly enough? Well, that could be that inflation gets out of control, basically. Their tendency over the last, say, couple of decades, and the reason why inflation's never really gotten too crazy over the last couple of decades, is that the Fed knows it's fairly easy to fight inflation. It's much harder to get an economy going because that's not just a Fed thing. You've got to have the cooperation from the branches of government as well, the legislature and the president, all kind of coordinating, because sometimes, like we found after this last recession in 2008, 2009, that we had maybe not a recession, but very, very slow growth. It was very difficult to be able to get the economy going again. So this has been a long recovery, and it hasn't been up until recently the growth has taken off. So the Fed would much rather fight the battle of inflation, of trying to contain things later on, because really all they have to do is raise interest rates. It's not that hard. It's painful, right? But it's not that hard from a policy standpoint. Versus getting the economy going, there's only so many tools in the toolbox, and that's a coordinated effort, not something the Fed can control alone. Another question from Mark. He said, I thought you mentioned that medical inflation was going to happen with Medicare and Medicaid, and that's true. That is going to cause a lot of economic disruption, but there's also some disruption that's going to be coming from advances in medical technology, and that's what we're hoping is going to be a lot of the solution for the out of control expenses. I think we'd all agree that medical expenses are crazy. I have clients that are in their 60s that retire before Medicare age and trying to figure out how to get health insurance. And unless they were a government employee or they were lucky enough to have a company that provided some kind of medical coverage after retirement, most don't anymore, by the way, they are paying really high premiums, like $900 plus a month for even a bronze plan, which would be a very high deductible plan. So that's one thing that we haven't quite figured out yet as a society, and we're not going to get into politics here, of course, but that's one thing we haven't figured out is we've made it accessible. We've made healthcare very accessible to everybody, but at what price? Are people really able to afford it? And that's one thing that we've seen healthcare inflation over double and sometimes over triple what core inflation is. So I know that's not really a solid answer, but that is one area that definitely contributes to higher inflation, whereas we may have other areas of the economy. If you kind of look at the basket of goods and services that go into the equation of the consumer price index, you can see that that's one component that actually is really, really high. So good question. So where we are, still uncertain about the etiquette of selfies. Again, a little bit of fun we try to throw in here. And again, it's, I think, pretty interesting to find out even how do they arrived at these numbers, but who would admit to some of this stuff. On the far right there, selfies while riding a public, which would be a bus, while in the bath, while attending a funeral. Thankfully, there's not many people that say that would be okay, but pretty crazy that people would even own up to that. All right, still in the second longest U.S. expansion. So some fears, and this is probably what I'm trying to do more than anything, is relay the stuff that I'm hearing as far as what are people afraid about, what are people worried about, not just what's in the financial media, but what am I actually hearing from clients and other people out there that I'm visiting with. So we are in the second longest expansion, at least since World War II. And more than likely, unless there's something really crazy, knock on wood, unless there's something really crazy that happens, this probably will end up being the longest expansion that we've ever had in modern history. So that's a fear. Then that comes up, well, gosh, doesn't that mean that the party has to end, that we're basically on the verge of an economic collapse because we've gone too far? And normally, you probably could say some of that. You could say that, an expansion, if it goes on too long, maybe there's a lot of pain on the other end of it. The one thing that actually buys us some time here, though, is the fact that most of this expansion has been a very, very slow expansion. So GDP growth has not been going up dramatically. Most of the time, the economy was barely taking out any gain at all during the last 10 years or so. That's one thing to keep in mind, is that in a slow recovery, it's kind of like jogging versus running. If I went outside right now, which it's really cold right now, so I probably wouldn't. I think it's in the teens. I think this morning my car said -4. Yikes. But if you look at the the concept of going out and jogging around the block and then running around the block, I could go a lot farther. I could probably jog all day if I wanted to. That's my favorite exercise, by the way, is running. But if I was running, if I really was kicking it up to race pace, obviously there's only so far that I'm going to be able to go before I just run out of steam. So that's one concept to think about here from an economic standpoint, is that because things were going so slow, especially during the last 10 years, really until the last year, especially maybe even couple of years, you've seen things start to tick up. Again, we're not going to get into politics. Some people would say, obviously one end would say, well, yeah, but it's because of all the policies that were enacted before and we're just seeing that catch up now, versus the other side would say, no, it's all the policies that have been enacted here recently. And clearly, economists disagree, and that's great. It's good to have the disagreement and to have the debate, but nonetheless, we do have the solid numbers that most of the last decade economic growth has been pretty paltry. And overall, people don't like to lose money. So that's one thing that we always spend time with our clients on, is trying to figure out what kind of losses are acceptable. And of course, most people would say, well, I don't want to lose any money. I want a great investment that's going to make me tons of money and have no risk. But unfortunately, that doesn't exist. That's not real. The highest paid thing that you can get right now that is guaranteed is probably going to be some type of a bond. And then there could be some debate, right, as far as the claims paying ability of whoever it is that's issuing that bond. But more than anything is that people don't like to lose money, and people's loss aversion actually has gone up a little bit over the last year. Of course, people think that they're a lot more risk tolerant than they are until things start to lose money, right, until they actually start to see the statements and their portfolio value drops. That's why it's so important to assess up front how much risk is acceptable, so we know during the downtimes what can we tolerate, without panicking and doing something crazy like selling out. There's a whole area of finance called behavioral finance that I've researched excessively, probably over the last 20 years. But the reason why I focused on that so much is that studies showed that the biggest detriment to people's actual investment experience or their actual returns over time is themselves. Actually, it's their own behavior. And that matters a lot more than did we pick, the wrong sector of the market to overweight, or do we put too much in international versus the U.S., or not enough bonds, or something like that. It's not that that's not important. That does matter on the margin, but the overwhelming thing that we have to focus on is our own behavior as investors. So the real key is thinking about Buffett. I think it was not Jimmy Buffett, Warren Buffett. But if you think about what people actually do as investors, they tend to buy when things are high or when things are low. When things are high, which I know we all sit here and say, well, that's stupid. Why would you do that? And then people tend to sell out when things are low, when they're panicking. And that's the very reason why people do that, is because they get scared. And we tend to be motivated as investors, left to our own devices at least, as we tend to be motivated by greed and by fear. And a perfect example of this that we've seen in recent history was Bitcoin. I'm sure everybody heard about Bitcoin. You don't hear about it anymore, right? Nobody's talking about it. But even just as of a year ago, it was just crazy about everybody talking about Bitcoin and how their brother and their neighbor and their spouse and their coworker, all these people trying to invest in Bitcoin. Well, where were the prices at the time? Almost $20,000, I think it got to at one point. Where is it now? Down in the 3,000, 4,000 range? I haven't even looked lately because nobody asks about it. But the interesting thing is that every type of speculative investment tends to see this huge boom. And there's always some bubble out there that people are throwing money at. But why are they throwing money at it? Because they get greedy. They don't want to miss out, in other words, right? Because they're seeing all these other people that make money and they hear the story. So I am spending time on this simply because I don't want you to ever get caught in this cycle. And certainly if you're using me as an advisor and listening to what I tell you to do, right, when things are crazy, is to avoid getting stuck in that trap of investing when everybody is greedy and investing in that thing, or selling out in a panic when things go way down. So another example, if you look back to the late 90s, which I was an advisor then, and everybody was talking about dot-coms, and everybody wanted to throw money in Yahoo and a bunch of dot-coms that don't even exist anymore. But that was the big thing, right? And you had investors like Warren Buffett that wouldn't invest in him, and he was heavily ridiculed at the time. By the way, a lot of people were saying, "Well, he's too old. He's washed up at this point. He's not changing with the times." And the reason why he wouldn't invest in most tech companies at the time was because, first of all, he said they're too expensive, so the prices are way too high. And the second thing is that he didn't understand the business model. He didn't understand how these companies were actually going to make money, and he was right. Actually, most of them never made money. Most of them never operated at a profit, and again, most don't even exist anymore. So we don't want to get sucked into that. We don't want to get sucked into the bottom end, like the financial crisis, where everybody's panicking, or it seems to be that everybody's panicking and wants to sell out because, oh my gosh, we're going to lose everything. Well, that's kind of what we've seen with Bitcoin, is that everybody wanted to buy it when it was at 20,000, and now nobody wants to buy it. So people that want to sell are getting very, very small amounts, probably based off of what they originally invested. Now, that doesn't mean that some of these things won't survive, right? The internet still is here, right? .com still exists. So it's not to say that that's not a business model that eventually ended up working, because it clearly did. And the same thing with cryptocurrency. It's probably not going away. I don't think it's going away. I think there is a role for it in the future, and maybe it'll actually reach some point of stability or some acceptance where people are really using it as a monetary alternative to the dollar. So it's not to discount that part of it. Certainly there's technology for those of you who are in the high tech field, really the blockchain technology. There are lots of components that major companies are using right now for a huge gain. But that doesn't mean that the original concept of the cryptocurrency is something you want to throw money at. So that being said, I know I spent a lot of time on that, but I think that's probably the most important thing I can tell you today is don't get sucked into either one of those, because this is what happens. This is what you end up happening in the overall market. This is just looking at the broad U.S. stock market, the S&P 500. And you can see back in the Great Depression on the far left there in 1930, for people who invested in the late 20s, obviously they saw some huge losses, and it would have taken quite some time, I think it was about 10 years, if you had gotten really, really unlucky and put all your money into the market at its high point in 1929, it would have taken you about 10 years to recoup all of your value. So you can see that was kind of an anomaly, but then we always thought that, well, that'll never happen again. And then we had the financial crisis where we were down about 50%. We saw the .com crash where we were down almost 50%. So and there were a lot of predictions, certainly at the time, from some people saying that it was going to turn into a depression, turn into a situation where we had 20-30% unemployment and mass poverty and so forth, and that didn't end up getting that bad. But clearly, you can see that the pattern is that every once in a while we do see a big market drop. Sometimes they last just for a little while. Sometimes they're really severe and they go way down. But the good news is that expansions are much higher on the other end of them. That's what's happened every single time when we've seen a bear market. It stinks, right? It doesn't. We're not saying that it's not saying that it's a comfortable thing to go through that, but if you can look at history and look at what happens on the other end, you're very much rewarded, not only if you stayed in, but especially if you were still working in particular, and you were still plugging money into the market, you're richly rewarded on the other end. And this 10-year expansion that we've been in, really up until this last year, and we saw the pullback, most of this last year has been very positive for investors that just stayed in and kept buying. So where are we in the business cycle? The answer is we don't know, and it wouldn't matter which economist you got on the call today, they would tell you that. They would tell you that we don't know for sure, but we can see some signs of where things are. Certainly, China is in a contraction right now, and the interesting thing is that they're still growing at 6+% right now, which is over double the U.S. But one thing to think about is that China used to be growing up in the 20% plus range for really the last several decades. Their growth has been phenomenal. So them going down to 6.6%, I believe that's where their GDP growth was at the latest report. That's like, for them, it feels like it's a recession. For them, it feels terrible. Partly that's due to us, to the U.S., putting pressure on them from a trade standpoint. So that certainly has hurt them more than it's hurt us. But also they've got some demographic issues. They've got some issues where they've tried to prop up their economy for some time to keep it growing at faster levels. And a lot of our clients that are working for global companies that end up visiting China, they'll tell you that if you travel around, you'll see all these like cities that are empty. Basically, you'll see these the housing, the businesses, the skyscrapers, things like that. There are whole areas that are just completely empty that were built for nothing. Basically, there was nothing there other than the government's desire to spend money to try to prop up their economy. So that's one thing that they're going to be working through some slower growth for quite some time at this point. It's also demographic because their population growth has dropped off considerably. And they don't have the advantage that we do, in that we've got a free market and that we've got a largely technology-driven economy, versus on China's end and some other areas of the world they've tried to grow, and it's worked up until now strictly by having a really big population and growth up to a certain point. And where are we headed? Of course, we're headed towards a recession. Like I said, winter is coming. That's going to be coming sooner or later. I think based off of what we've seen here recently and the other data, as far as predicting economic growth, where we are from an unemployment standpoint, and unemployment continuing to go down, I think we have some time. I don't think that the winter or the recession is right on our doorstep, but it is coming. And as you can see here from the quote, they're very difficult to predict. Otherwise, we'd be very rich and all retired right now. It's very difficult to predict both the start of a recession and the end of a recession. So the one thing to keep in mind, though, is that 10 to 12% of the time, historically, if you look back through market history, which modern market history we would track back to the 20s. Some economists will go even further back, but back to the 20s, we've got pretty reliable data. About 10 to 12% of that time, we've been in a recession. We've been in either no growth or even a negative period of time. So it is actually pretty routine that this happens. But the good news, again, like we saw on the slide before, is that expansions are much bigger than contractions. And I think it's just the story of human experience, right, is that we're always looking, all the companies that our clients work for, certainly Keystone Financial, we're all, as business owners and as individuals, trying to figure out better ways to do stuff, right? We're always getting more efficient. So that's one thing that we can always count on as far as growth, is that we're figuring out better and bigger ways to do stuff. Obviously there's other factors. One of those is geopolitical risk. We won't go through every single one of these areas because it's kind of like just being afraid, right? Afraid of what could happen. But the reality is that there are global risks out there, global events that if they were to unravel in a bad way, it could have a huge impact on the rest of the world. It could be very disruptive. For example, a major terrorist attack. We're getting into a conflict with China in the South China Sea. The one thing to think about here is that if you were trying to make your investment decisions based off of any of these things, you would almost certainly be making some really bad choices, because your likelihood and my likelihood of being able to predict exactly what's going to happen in some other part of the world or in politics, very, very difficult, which is, what makes things interesting, of course, is that every day things change, right? There's all kinds of stuff that comes up that we didn't expect. And sometimes even something that looks really negative and it even happens, sometimes it ends up being a real positive, just in a very unexpected way. So keep in mind that the things that are probably on a lot of people's minds, though, economically, are U.S.-China relations. Certainly, if we get a trade agreement between us and China, that would take away a lot of uncertainty. You can see that today. Actually, I think the last time I looked, the Dow was down 350 points because the meeting may not happen in time for the expiration of the agreement with China to push off some of the tariff increases. So I wouldn't worry too much about that. It's not that hard for them to extend that, but causes a lot of volatility when you're talking about the two biggest countries in the world, the two biggest economies in the world. So I wouldn't put too much stake in any of these things, but certainly any of these hot spots in the world can have a major impact. And then again, bearish versus bullish, this kind of jumps back and forth. And certainly you can see investors turn bearish in December of this past year. And the one thing to keep in mind is you look at the chart and you think about when would the best time to invest would have been. Well, actually, when most people are bearish, right? And back to that Buffett, I didn't finish my quote there. Buffett says, be fearful when others are greedy, and greedy when others are fearful. So let me say that again. Be greedy when others are fearful, and fearful when others are greedy. And the one thing that I always find interesting is that the source here is from the American Association of Individual Investors. And that's actually kind of a microcosm of everybody, right? But the average investor does stupid things. The average investor buys when things are really high and they sell when things are really low, which again, we're talking about this over and over because it's so important not to be that guy. You don't want to be that investor that gets sucked into being driving all their investment decisions based off of their emotions. The one thing to watch out for too is watch out for the financial media, because the financial media is there to scare the pants off of you, especially when things are tough, like in December when the market was going down. Well, they're there to scare the pants off of you and I, because that's what sells news, right? They're there to sell ad space. So put a healthy shield up in front of you to that stuff. Whatever media is that you consume, whether it's conservative, liberal, it's all the same from the negative standpoint, in that that's what sells news and they know it. So keep that in mind, that you're, especially if you see the market drop or you hear that the market's dropping, pulling up CNBC or gluing yourself to Bloomberg or something like that, probably not the best idea, because it's just going to scare you at a time when you probably would be tempted to do something stupid like sell. So where we may be going, ultimately money doesn't buy happiness. We know there's been a number of happiness studies, and at least from an economic standpoint, the researchers say that at about $75,000, at least in the U.S., about $75,000 of household income or above does not buy additional happiness, because at that point, most of our core needs are met, right? As far as housing, food, healthcare, things like that are probably covered by that kind of a budget. So above and beyond that, obviously we can do a lot of fun stuff. We can have a lot of experiences, but ultimately, based off of what you're spending that money on, if it's all just from a consumption standpoint and buying stuff, that does not buy happiness. What does buy happiness, though, at least from a tracking standpoint, is investing in other people, investing in memories. We get to enjoy this with our clients, right? We get to work with a lot of people that now are in the stage of their life where they've got the income, or maybe they're even retired, where they've got the wealth, that they can have a lot of experiences with their family, with their friends. They can go out and help other people in the world. Certainly they can go out and invest in other people, like helping with a college education for a family member. So one thing to keep in mind, again, is that money doesn't buy happiness, but it also doesn't buy happiness to not have money, right? That's the opposite of that, is that there's a lot of good that money can do. So it's all how we're treating it, right? What kind of values that we have that are associated with our money. So going forward, then some countries are expected to grow faster than others. Of course, that's always the case, right? You always have some areas of the world that are growing faster. But one thing that continues to hold true is that the fastest growing economies do continue to be emerging markets. So Southeast Asia certainly continues to be, Africa continues to be a very high growth area. Certainly your more developed economies like the US, like Western Europe, Japan, Australia tend to be growing slower, but still growing at a healthy rate. So not in a recession, in other words. There's very little of the globe right now that really are in a recessionary period, other than some political hotspots like Venezuela. So keep that in mind, that most of the world actually is growing right now. Global growth is good. Emerging markets are growing faster, but of course, those emerging markets are politically unstable. Most of them are very unstable, which is why we don't invest heavily into those areas, because you could have a very quickly growing economy, but have some political risk of upheaval, or certainly if they're not capitalistic, you could have a lot of crazy stuff that happens. So that's why we invest in those areas, but oftentimes either by having a small amount of actual companies in those areas, or we'll invest in big global companies that might have exposure to those areas, but they may not be headquartered there. So again, looking at the individual countries, you can see China 6.3%. If people didn't know better, they'd probably say, wow, China, that's a great area, but they're actually decelerating right now. So keep that in mind, is that you're seeing that pull back. India is actually accelerating. Other areas of the world, certainly you see low growth continuing in Europe. Latin America, a lot of instability, certainly thinking about Venezuela in particular, but growth forecasts are mostly positive right now. Not many countries that we would say are in danger of going into imminent recession. And so one thing that happens, though, because we've seen such good performance in the U.S., and really the U.S. economy is still going to continue to plug along here for a while. So it's not to say that we're a bad place to invest, but you're just paying a lot more for it. International stocks are very cheap right now because of the perception that the U.S. is the better place to invest. So it still is good to have some international in your portfolio. And then finally, value stocks versus growth stocks. Again, this gets a little bit wonky in the financial world, but basically one way you can divide companies as far as categorizing them is growth versus value. And the most simple way to think about it is that a growth stock will be a company that's growing very quickly from an earnings standpoint. Their profits are going up very, very quickly. And because of that, their stock price has also probably been going up very quickly, and you're going to pay a lot for it. It's just going to be at a very high price that you'll be purchasing that stock for. So, one comment from Mark here, for example, was Amazon. Amazon is a very, very much a growth stock, even at being down 20%, I believe it is right now, still very much a growth stock. But people who would invest in Amazon invest in them because of their future growth. They think that their earnings are going to continue to grow fast enough that it doesn't matter what you're paying for it, because the growth is going to outweigh any premium in price that you're paying right now. So that's not how Warren Buffett invests. Warren Buffett's a value guy, and that means that he wants to buy stuff when it's cheap. He wants to buy things when they're a bargain. And a value investor, for example, and this is kind of crude, but they would say you want to buy when there's blood in the streets. You want to buy when things are really cheap. And the trick, though, is to know which value stocks are they're value stocks because they're cheap and it's maybe a misunderstood situation. Things have been oversold and it's going to come back, versus a company that's going to crash and burn. And there's plenty of companies like that too, right? Especially in recessions, lots of companies go broke. Most companies don't make it anyway. In fact, there's only a 4% chance that a company from its inception will even make it 10 years. That's looking at all companies, not just big companies, but small companies too. So it's a risky proposition. That's one reason why it's so important to diversify. But value definitely has been trailing growth. It's definitely been more of a growth market the last several years. We continue to invest in both. I think it's important to have both in your portfolio, because there's different time periods, different markets where value will do better versus growth does better. And in the later stages of an economic cycle, value does tend to start to do better, especially once we hit winter time. So thinking about the experts, obviously I'd say, well, I'm an expert too, but thinking about the big experts though in the media, you can see the quote here from Vito Racanelli from Barron's in the Barron's 2019 outlook, and that this coming year is expected to be pretty good, and good riddance to 2018. There were a lot of bad things basically that we didn't like about 2018 from a market standpoint and economic standpoint. But looking at 2019, we're probably looking at a much higher growth rate. Vito says about 14%. They're thinking the S&P will be up this year. Not bad, right? Because we're already up like 10, right? Something like that. So we may have seen a lot of the gains already. If he is right, we may have seen a lot of the gains already. Slowing growth, BlackRock is predicting that global growth will tend to slow, but U.S. will tend to be better than other areas of the world. We're still considered to be one of the best places to invest. And then eventually, even though they're saying it here, there's very little risk of a recession this year, that will continue to slow over the next couple of years. And then finally, from Rob Arnott at PIMCO, they're one of the biggest bond fund managers in the world. His comment here that people hate diversification, especially in a bull market. They hate diversification. So this is just reminding you to stay diversified, because it's very, very tempting to get undiversified when people see other people making a bunch of money on something else, or by putting all their money in one thing. So very important to stay diversified. And finally here, the stock market fell sharply today, then bounced back, spiraled upward, jumped forward, leaped to new heights, tumbled rapidly, and took first place in a gymnastics competition. Sometimes it feels like that. And the good news about a new year is it's a fresh start. Obviously, it's one of those things that 2018 is gone. We're glad that it's gone from a financial standpoint. If there's any stat that I'll leave you with that's kind of fun, is that the third year, and this is not attributed to any particular political party, but the third year of a president's first term tends to be the best year. The second year actually tends to be the worst. We still didn't think last year would be a bad year. I'll turn back on my webcam here, but we still didn't think last year would be a bad year, but it certainly did, and 2019 looks to be much better for us. So my prediction, I think we're still going to end up being positive for the year. We may have seen a lot of the growth already. My best guess is that we're going to be up somewhere in the 14 to 17% at the year to date as of December 31st. So we'll see if I'm right. Obviously, we may not know, but we're certainly off to a good start. We've already seen at least half of that materialize, but there's a lot of time left. So with that, I'm going to open it up for any questions that you've got. I know people are busy too, so if you've got to pop off, feel free to do that. One thing I will let you know, though, is we have a handout in the handout section. We just came out with our Keystone Financial Data 2019 piece, which actually gives you a lot of the key financial data that you would be interested in to plan for 2019, especially for taxes, Medicare, Social Security, things like that. We've got that piece that you can actually pull off. It's a PDF you can pull out of the handout section of your GoToWebinar toolbar. So with that, again, I'll open it up for any questions that you've got. You can see a picture of my team over here. This is out on the deck when things were warm. It wasn't today, believe me. It's pretty cold outside. But yeah, I'll check the questions queue here. So let's see what we've got. Yeah, let's see, just a comment here from Mark. He said, would you please post a video of this so that my wife can view it? Yes, absolutely. We have a recording of this, and we'll make it available to all of you to be able to pass on to anybody that you'd like to. So you can certainly do that. Let's see, any others in here? I don't see any other questions for right now. That doesn't mean that there won't be any later, or you just may not want to ask it. So you can certainly email me at josh@keystonefinancial.org, or give me a call. Just for sake of time, I'm going to wrap it up, but thank you so much for attending the presentation today. If there's anything that we'd like to follow up on, certainly connect with me. I'm always open, even if it's just a short phone call or a quick question. Always want to be here as a resource. Definitely appreciate your support as clients and maybe prospective clients. Hope you join us real soon to come to the next presentation, either by webinar or by live format. Thanks for your partnership, and if you've got anything else that you need from us, just let us know. Take care. Thank you.